Okay, say hello to the first Vienna Donna Pantano YouTube short video made on the Yield Boss platform and social media content patrol. So we're going to talk quickly about PCE today because we had our new numbers come in, which were 0.1% lower, as you guys can see on Forex Factory. Use Grok a lot if you want to check the previous numbers. It's important, but what I usually look at and what I take into the most consideration over CPI and PPI is PCE, because PCE is the Fed's preferred method of measuring inflation. Okay, when the Fed talks about their 2% inflation metric that they're trying to get the market down to by raising interest rates and keeping rates up at that 4.25% to curb everything, it's because PCE tracks a wider evolving trend of categories which are consumed across the country per household in real time. Okay, think about all the money that households are spending is not tracked in CPI. You have to remember that CPI it's a more narrow survey, so it's basically what households say they're paying out of pocket regarding a fixed basket of goods and services, as opposed to PCE, which is a little bit more broad, and it's also based on business reports in a household. It's based on insurance. It's all CPI goods and services, and the main thing is that it adjusts for how people change their buying habits in real time. Okay, CPI is more like every single quarter or every single month what is going on in these specific categories. But for PCE, it's more of a revolving door of information with all the little purchases that CPI is not picking up. Okay, so we are at this number right now. We dropped 0.1%, as you guys can see, month over month. The new number came in at 2.1. It was 2.1. Expectations were 2.2. Here is your issue with this number. Okay, while this is month over month, and that's a good way to track things, what we're really looking for is PCE year over year. Okay, so going all the way back and checking back to January of this year, which was measuring December's PCE inflation, we are at 2.6%, and now we're at 2.8%, and then 2.3%, and now 2.5%. So you can see the year over year isn't really changing. Even though the month over month may be coming down, same with CPI and PPI, the PCE year over year, which is really what matters most and carries a lot more weight, because it shows a more broader, super macro perspective of what's going on in the market with inflation, it's not moving. So if you were expecting the market to squeeze big time here because of a 0.1 month over month number, that's why SPY is continuously gapping down. Right now, it opened at 589. It's 584 right now. So expect the S&P to move down more into the window of weakness that we are in, all the way into non-farm, which is next Friday. Okay, remember non-farm at the first week of the month on Friday shows the payrolls for not including farm jobs for the month prior, and that is when dealer flow really begins to amp up. Dealer flow is going on at all time with Vanna and Charm decay. Okay, boosting the market up into your monthly OPEX, but it really starts to hit because those options really begin to decay after non-farm each and every single month. Okay, so looking at this inflation report, are things good? Not really. They have been stagnant. They've been stagnant for the last 5 months, and they will continue to be that way. The only way they are going to be able to lower inflation is by having the market make some type of correction, deleveraging, or raising interest rates. Three of those together, right now is not suitable. So expect inflation to stay high, expect your goods and services to stay high, and expect the Fed to stay on course with their 4.25 federal funds rate at this moment in time until something major happens in the near future regarding tariffs or whatnot. All right, love you guys. Chat soon.